going on, YouTube? In this video, we're going to talk about air test systems, ticker symbol AEHR. So company reported their earnings on October 5th, beat on top and bottom line, and analysts have revised their next quarter expectations lower. Year to date, company is up 41.7%. Over the course of 1 year, it is up 1.6%. They do have a large amount of short interest against the company, sitting at 24.3%. So something to keep a little bit of an eye on. If we start seeing some price action move up, we might see a little bit of a, I guess, a quote unquote short squeeze, where we might see some short coverings if this company decides to make a move higher. But we'll get into that here shortly on the financials. So what this company does is they make these wafer systems, these machines that test their wafers, that semiconductor companies make these wafers, and then Air Test Systems produces these systems. They have automation and some sort of contacting, maybe some sort of pad to maybe see if all these wafers, it looks like a wafer form there that it might fit right into, to test to see if these wafers meet standards and are able to get shipped out to their customers. Air Test Systems makes these testing systems for these wafers for semiconductor companies, and then those semiconductor companies test their wafers that they make, and then they ship those out to their suppliers. So 80% though of Air's revenue comes from ON Semiconductors. So one thing we want to make sure with ON Semiconductors is not only what they do, but also their revenue forecast. So the company produces semiconductors for the cloud server and telecom infrastructure. They also produce chips for industrial automation, energy infrastructure, and smart buildings. And they also make chips for intelligent power and sensing technology, so your cars, your vehicle. They also make chips for power management and interfaces for mobile services. Now, the first thing we want to take a peek at is the future forecast. And this is on Semiconductors on their earnings call. And in their earnings call, they reported stating that they do see a reduction in demand. It will impact their current revenue. However, that is 4 times last year's revenue. Also in 24, they're expecting growth of their silicon carbide business to double in the market. Currently, they're experiencing short-term reduce in demand, but long-term, they're seeing very positive growth. So one of the negatives, the big negatives to this company though, is the fact that ON Semiconductors is 80% of their revenue source. So if anything was to happen to ON Semiconductors, it could very well impact Air Test Systems dramatically. However, Air Test Systems is working on introducing their product to several other customers. Hopefully in the future, they can find more revenue sources and diversify their revenue streams. So over to their earnings report, we're on their balance sheet. Company's got $51 million in cash. They've also, here's another negative to the company though. So the negative number one is going to be their revenue source, right? It's from basically 80% of it is from one company. Number two is their inventories. Their inventories are up quite a bit. So this is just in 3 months. They're up about $7.6 billion there. So that's a big hit to their cash flows, and that's something that a lot of investors don't like to see, is an increase in inventories. So that is number two to take away and keep an eye on. Very good balance sheet. We've got 51 million in cash, 25 million in total debt. You subtract debt from cash, you're still left with a positive cash balance sheet. So that is always a very good thing. Now down here to our revenue, we've got $20.6 million in revenue. Year over year, that is almost doubled. So we deduct out our total cost of revenue, we're left with gross profit down here, and we can come over to here and see that 42% was what we made for margin growth or margin. And then in 2023, the most recent quarter here, we're up to 48% on margins. So margins are growing, which is fantastic, which is always very good. So maybe they can continue to grow those margins a little bit in the future. If they're able to grow at 6%, they can maybe get another 3-4% out of their margins, maybe even a bit more. But we'll once we get to the comps, we'll understand better of what a potential profit margin is to be expected. So then that leaves them with a net income of $4.7 million compared to $589,000 last year. We are still seeing a little bit of dilution on the share count also. So we come down to our cash flows. This is over the course of 3 months. Our net income is $4.6 million. We add in stock-based compensation of $522 million. Last year, $710 million. So they have reduced stock-based compensation. So that's a positive. And here's our inventory hit. We got $7.7 million of inventories deducted from our cash from operations. And then that leaves us with $3.9 million of positive cash from operations. So then we also have to deduct out our $284 million of cash or our capital expenditures, which then leaves us with $3.6 million in free cash flow in 3 months. And over the course of 4 months, we're looking at $14 million annualized free cash flow. So they're positive balance sheet and they're positive free cash flows by not just a little bit, but quite a bit. They can increase their balance sheet by 50% in 1 year. So that's very good with their cash flows alone. But if they can clean up these inventories and reduce those inventories, that's going to increase their future cash flows a little bit. And obviously, if you maybe cut those cut those inventories in half, you can only imagine what your cash flows would look like. So your cash flows on this company would be fantastic once they start trimming off some of that inventory. Over to the financials on the company, we're going to just go over a quick basis of how the company is trending, and we can see on our revenue, gross profit, net income, we are in an upward trajectory and a very nice clean one as well. We've got our gross margins. History is telling us we've been actually trailing 12 months is 51.1%. Last quarter was 48%. Net margins trailing 12 months, 24.9. Last quarter, 22.7. So margins are coming down a little bit on the last quarter. Maybe they can get those back in the coming quarters. Growth rate on revenue and gross profit sitting at about 15 and then 16.8%. So still pretty good growth. Return on invested capital sitting at 15%, very solid. And there's our balance sheet numbers. We are doing very good on cash to debt. Net income to free cash flow. Company does produce, obviously, we've already seen positive net income and positive free cash flows. Our share count is still slightly getting diluted as we have seen, and we can see our capital expenditures are starting to tick up a little bit. So two other companies to compare to, we have Teradyne and ATEYY. And we come down here to our chart comparisons. We have our market cap that we can't really utilize that well because Air Test Systems is such a small company. So we'll ignore that, but we can definitely see who the market cap leader is on the board here. So revenue, gross profit, net income, we got the same thing going on here. We can't really tell how well AR is doing compared to Teradyne because we're so little, but we can come down here and see our margins. And we can see that we can potentially squeeze another 3-4% out of our margins yet to match up with the competition. But if we are able to do that, some of those margins might carry over into operating and profit margins, and they're already the leader in those two margins. Well, not quite there, but they are in profit margin range. So if they're able to increase their gross margins by 3-4% and carry some of those margins up or over to profit margin, they're going to be doing very good margin wise in the business. Return on invested capital, they could also do a little bit better job there. Obviously, invested capital will take time to grow. And earnings yield also same thing. It'll take a little bit of time to grow in there, but they could obviously be doing a lot better on that. Price to earnings, you are going to be paying a little bit of a premium for this particular company based on competitors. Peer Valuation gives them a $39.76 price tag, and over at multiples comparison between the two companies we just compared to, it's $22.33. Manual PE, we take our market cap minus cash, add in debt, divide by cash from operations. It'll take this company 83 years to earn its current market cap. So that is very richly valued right there. Price to book, 5-year average, 6.6, currently sitting at 9. So again, very rich on the price to book compared to where it has been. PEG ratio, today, 0.76. That is telling us we are very undervalued, and forward looking, we are also incredibly undervalued. Graham's Valuation gives them a price tag of $66.57. Over to the free cash flow calculator. History is telling us their average growth rate is 118%. Analysts did not have a growth rate listed, and I gave them a 50% growth rate on free cash flow for DCF price per share of $16.03. Rule 72, we have 3 sources for an EPS growth rate. However, we cannot expect a 10-year EPS growth rate of 53%. So I cut that down quite a bit. I gave them a future EPS of 2.3, which is still significantly higher than where it is right now. That gives them a fair value today of basically $61 per share. On to the summary. Currently trading at $25.34. Our fair market value is $41.14. A 30% margin of safety in case we are slightly wrong on our analysis gives us an acceptable buy range of $28.80 per share. Over to the stock chart. Company is locked into a downtrend. We are on the daily chart here. Locked into this downtrend. We have seen support down here about $21.50. maybe call it $23-ish per share, in that range. Bounced off support, potentially could see this thing run back up into this lower trend line and then come back down and create a little bit of a wedge here. And then maybe in the future, if earnings continue to hold up and continue to show some real strength, then we might see a pop out of this channel. But in the meantime, I don't think this thing's just gonna come right back up to here. I think what it'll happen is very common, is this will come up, retest this trend line, pull back to support, and then finally find its way out of this channel. Probably find its way out of the channel on a future earnings release is more than likely the case on this one. This one, personally, I would sit on the sidelines for a little bit. It does appear to be a good deal. They do have a couple questionable things within the business, such as where their revenue comes from, which is 80% from one business alone. And then obviously their inventories. We need to see those inventories shrink as well. But overall, the financials on the company look very, very good. Their earnings report that they gave out was very bullish. And I can't say too many negative things about this company. I just think there's a little bit of risk behind it just because of the one business that they are associated with. So that is it for Air Test Systems. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.